From 2018 up until the beginning, or not really the beginning of this year, but probably Q4 of last year, you could have calculated an incredibly tight correlation between the stock market and the Fed money printer. From 2018 up until about Q4 of last year, there was a 0.92 correlation between that and the S&P 500 going up. What does that mean? A 0.92% correlation effectively means that for every dollar the Fed created, the stock market was going up by that same dollar. And that is literally what we had up until November of 2021. Since the beginning of this year till about yesterday, so I think the number is still going up, probably by at least by $1 trillion, we have destroyed collectively as a society $35 trillion in global market value. Now, to give you a sense of that, that's 14% of all global wealth that has been destroyed in basically 5 months. And for reference, in 2008, when we went through, a cataclysmic shock to the system that threatened the banking infrastructure of America and a potential contagion to the world, that destroyed 19% of the world's global wealth at that point. So, we're approaching some really crazy, heady moments in time where, in terms of the market correction and the value destruction. The difference here is that the last time around, it was really about a handful of financial institutions and some very specific assets, right? This time around, it's literally everything that's getting smoked. There is not a place that you can effectively hide that has been safe. Crypto, smoked. The credit markets, totally frozen. The equity markets, NASDAQ is in a bear market. The S&P is basically flirting with the bear market now. And I don't really see any end in sight. It's not clear that there is the momentum to create a market bottom. Just to be clear, we actually haven't started to remove the money in the system. So the process of quantitative tightening, which is the Fed's mechanism of removing liquidity, is going to start now to the tune of about $90 billion a month. But to run off all the money that they printed will still take 3 years, right? So we have to take about $3 trillion of excess capital out of the economy. And so if you add that 3 trillion as well, that's just going to disappear to the 14 trillion we've already, or the 14%, the 35 trillion, sorry. You're starting to touch numbers that are, as bad as the GFC in terms of global wealth destruction. Now, you can say, what is the canary in the coal mine? And let me just give you one thing that hit the wire this morning, which will show you how bad the credit market is. So there was an article in Bloomberg that came out that said, instead of Elon taking margin loans to fund his acquisition of Twitter, there is an idea being floated by Morgan Stanley to use convertible debt. What it said is, I'll just read this to you. The preferred equity may have a 20-year maturity and include a feature allowing interest to be paid in kind at a rate of 14% a year. If the single greatest investor's cost of capital for debt in today's market is 14%, I think you have to really start to question what the credit markets really look like for market clearing prices. Because if that's the price for a risk-bearing asset run by the greatest entrepreneur of our generation, there's a bunch of stuff that's pretty mispriced.